Hi, hello, this is Steve from thegreshko.com. This video will touch on the short straddle setup and its profit and loss opportunities. Selling straddles typically involves simultaneously selling a call and a put of the same strike price. Typically, you see straddles sold on the at-the-money strikes, straddles that have a neutral market outlook. However, depending on bullishness or bearishness of the strategy, you can pick the strike of your straddle to reflect accordingly. If you're bullish, for example, you can pick a higher strike price as the center of your straddle. And if you're bearish, you do the opposite. As a trade structure and margin requirement, it's equivalent to an iron butterfly, only without the hedges or the long legs. Like a condor or a butterfly, your broker would most likely require one side max loss as margin, since price can only hit maximum one strike at a time. However, due to the absence of hedges, margin requirements are higher and margin required can expand when using this strategy. Opening this trade means that you expect the price to more or less be around the area of your strike within the time period of the option you sell. Being a net seller strategy, your goal here is to keep as much of the premium initially collected, either by letting the sold options get cheaper through time decay or taking advantage of the excessive implied volatility priced in your sold option. Advantages to the strategy are the following. Number one, only one side can lose. We take in double the credit for selling two options for one side potential loss. Number two, the absence of hedge results in a higher premium collected to compensate for higher potential risks we take. These two factors give us a better allowance for error, widening our break-even price. Break-even price in terms of strike price is either one of the short strikes hit minus the net credit received over 100, or simply use the net credit with the original decimal numbers in your trading platform. I'd like also to warn you that this strategy is not suitable for small accounts simply because of the higher margin requirements of this naked strategy, and number two, the high potential losses that can wipe out a very significant portion of a smaller account. This is also one of the favorite strategies when doing earnings play, because this strategy is taking advantage of the high IV to sell premiums and expecting a drop afterwards.